You tap your credit card for a normal purchase. Coffee, groceries, a subscription. The payment goes through in seconds. And at the end of the month, you do everything. Right? You pay the full balance, on time. No delays, no interest. So here's the real question, and it's the one most people never ask. If I didn't pay a single dollar in interest, how did the credit card company still make money? Today, we're going to follow one credit card swipe rule step by step and reveal the hidden money trail most people never see. When people hear credit card profits, they usually think of interest, the extra money charged when someone doesn't pay on time. But here's the twist. A credit card isn't only a lending product, it's also a payments product. And the payments side can generate revenue even when you pay in full. By the end of this video, you'll understand what happens in the 2 seconds after you tap your card. The invisible fee that moves behind the scenes. Why rewards still make sense for banks. The other fees that quietly add more profit, and how to use credit cards intelligently without getting trapped. To understand the money, we first need to meet the characters. When you pay with a credit card, 5 players usually show up in the background: you, the cardholder; the merchant, the store or website you're buying from; the issuer, your bank, the one that issued your credit card; the network, Visa, Mastercard, American Express, Discover; the acquirer, processor, the merchant's bank and payment processor, that handles transactions. Even though it feels like a direct payment from you to the merchant, it's actually a system, like an international highway built to move money safely and fast. And like any highway, it charges tolls. Let's say you spend $100. Your receipt says $100. Your statement says $100. But the merchant usually receives less than $100 after settlement. Why? Because the merchant pays a set of fees for accepting card payments, often called processing fees or merchant fees. And these fees are not one single charge, they're a bundle. Inside that bundle is the most important piece of this entire story: interchange. Interchange is easiest to understand as a toll. Every time you use your card, the merchant side of the system pays a fee that goes to the issuer, the bank that gave you your credit card. That means even if you never pay interest, your bank can still earn money when you swipe, not because you borrowed, but because you spent. Interchange rates vary depending on the country, card type, merchant category, and whether the transaction is online or in person. In places like the US, interchange can be around a couple of % on many transactions, while parts of Europe have lower capped rates. So if millions of people pay with cards every day, those small percentages become massive revenue. Now you might be thinking, okay, but the merchant pays the fee, not me. So why does it matter? Because in the real world, costs don't disappear. They usually get redistributed. Many businesses price products knowing they'll pay card acceptance costs. So even if you never see a card fee printed on your bill, the cost can still be embedded into prices. That's why interchange fees are often debated globally and, in some countries, regulated or capped. But from the credit card industry's perspective, the concept is simple. The system gets paid whenever you use it. Here's another detail many people miss. Visa and Mastercard are not banks that lend you money. They are mostly payment networks, like the global rails that connect banks. And because they operate the rails, they charge their own fees, often described as network or assessment fees, paid as part of transaction processing. So one transaction can generate revenue for multiple parties. The issuer earns interchange the network earns for operating the rails. The processor earns for handling the payment service. This is why credit cards can be profitable even when you're a perfect customer who pays in full. Now we move into a concept that sounds boring but matters at scale: float. You buy something today. The merchant is typically paid quickly through settlement systems, but you might pay your card bill weeks later, near your due date. That time gap, combined with huge transaction volume, can create financial advantages through cash management and short-term funding mechanics. To be clear, float isn't the biggest profit driver compared to interchange or interest. But it's one more reason the system still benefits from your activity, even if your personal interest cost is exactly zero. And once you see the business model this way, another piece starts to make sense: annual fees. Many credit cards charge an annual fee. Sometimes small, sometimes very high. Why would someone pay $100, $300, even $500 a year for a card. Because premium cards bundle benefits, airport lounge access, travel perks, insurance coverage, elite status, concierge services, and partner discounts. For the issuer, annual fees are predictable revenue, basically a subscription. And when annual fees combine with interchange from spending, a customer can be profitable even without paying interest. But not everyone pays annual fees. So credit card companies have additional revenue streams. Let's talk about the fees that aren't interest, but can still generate significant revenue. Common examples include late payment fees, foreign transaction fees, cash advance fees, balance transfer fees, return payment fees, and penalty charges. Regulators and central banks often categorize these as fees and charges, or non-interest income, that can meaningfully contribute to issuer revenue. Here's the important point. Credit card profitability isn't dependent on just one thing. It's built like a multi-layer machine. Spending creates interchange, premium segments pay annual fees, and mistakes trigger penalty fees. And then we reach the part people love the most, but understand the least: rewards. Cashback, points, miles. Rewards feel like the credit card company is giving you free money. But here's the reality. Rewards are usually funded by the economics of transactions, especially interchange. Think of it like this. You spend, the system generates fees. The issuer earns revenue, a portion is shared back as rewards. And it gets even more interesting. Premium reward cards can come with higher merchant costs in some systems because richer benefits need funding. This is why credit card rewards are carefully engineered. The issuer knows that. Not everyone redeems rewards efficiently. Some rewards expire. Some people overspend chasing points, and some people eventually carry a balance and pay interest. So rewards can be a win for disciplined users, but they're never random generosity. If you use them strategically, great. If you use them emotionally, the system wins. And that leads to one more modern layer that quietly shapes everything: data. Every card purchase creates data, spending category, frequency, location patterns, lifestyle signals. Banks use this data to detect fraud, assess credit risk, personalize offers, and cross-sell products like loans, insurance, and investments. Even if consumers rarely notice it, transaction data improves the business in ways that can increase long-term profits. And once you put all these layers together, the main conclusion becomes clear. So now we can answer the question we started with. If you didn't pay interest, how did they make money from you? Because your swipe created an invisible trail: interchange revenue, network fees, processing income, annual fees for some customers, and fee income when people slip. Interest is a major profit source. Yes, but it's not the only chapter in the book. In many cases, the system profits from you simply because you're active, because you spend. That's why credit card companies don't only want customers who borrow, they also want customers who use the card all the time. Now the practical part. How do you benefit without getting trapped? Here are simple rules. Pay in full, on time. Every month. Avoid cash advances. They're usually expensive immediately. Check foreign transaction fees before traveling or buying internationally. Don't overspend for rewards. Rewards are smaller than impulse spending. Only pay an annual fee if the benefits match your lifestyle. Set alerts for due dates and spending thresholds. Used correctly, a credit card can be powerful. Convenience, protection, rewards, and building credit history. Used carelessly, it becomes a fee machine. So the next time someone says, "I pay in full, so the bank earns nothing from me," you'll know what's really happening. Behind every swipe is a system designed to earn, even when interest is zero. If this breakdown helped you see credit cards more clearly, like the video, share it, and subscribe for more finance freedom, simple language, real-world logic. And comment below, what should the next video be? Cashback versus miles, what's actually better? Or the truth about credit scores?